Hi, I'm Frank Warnock, a professor here at Darden Business School. We're at the 2012 University of Virginia Investment Conference. I'm sitting today with Dennis Lockhart, the president of the Federal Reserve Bank of Atlanta. Dennis, welcome.
Thank you, Frank.
It's wonderful to have you here. I think the first question people would have of a Fed official and an FOMC member is about the state of the U.S. economy. So I was wondering if you could start first just talking a little bit about how you view the economy now and in the near term going forward.
I see signs now of some firming. There have been some positive signs we've seen in the last few weeks and perhaps last few months. Housing sector is a little bit better. The industrial sector has picked up a little bit. Consumer activity is staying, holding up. Having said that, I still have an outlook of modest growth. I think inflation will stay close to the Federal Reserve's or the Federal Open Market Committee's target of 2%. And I think the likely course of employment gains is very gradual.
Okay. And the employment gains, I think, are very important, right? If we start to think about another question that most people would have, the Fed's exit strategy from the current quantitative easing policies. Could you perhaps think of this as part of the Fed's renewed interest in communicating with the public? Can you help us think about the conditions under which the Fed will start to undo some of these policies?
Well, in the last statement after the September meeting, we established that this notion of substantial improvement in the outlook for the labor markets as a condition that then might give rise to the beginning of a normalization process, or you might call it a tightening cycle. The term substantial improvement will be built for the most part on the unemployment rate, but I've maintained that the unemployment rate in and of itself is probably too narrow a way of looking at the labor markets, that we need to look at a number of indicators. I call that a sort of dashboard approach to things, where we look at several indicators and try to understand really in a more fundamental way whether they indicate improving health. So that would be certainly one basis for beginning to remove accommodation, that we see genuine improvement in the outlook for the labor market.
And can you mention some of these indicators? So clearly unemployment rate, which you've mentioned, the new jobs number, the number of jobs created.
Right.
I guess the unemployed rate or unemployment rate.
Well,
so discouraged workers and things like that.
Beyond unemployment, there are underemployment.
Yeah.
So, for example, in some of the most recent jobs numbers, the growth we have seen has been to some extent part-time work.
Yeah.
Well, it's hard to conclude that the growth in part-time work is as healthy as the growth in full-time work. Right. So we would certainly want to look at the unemployment, the underemployment,
right.
Initial claims for unemployment, maybe some reduction in the length of unemployment, that we've seen a lot of people who've been out of work for quite a period of time. And then there are several others that are the labor economists consider to be important indicators of underlying health.
Now, when I talk to, let's say, the practicing managers, so professionals, a lot of them will still focus on the unemployment rate. So do you expect the Fed to come forward with more guidance on something like your dashboard or some of the indicators that are important?
Well, I don't want to speculate on what the committee will decide, but it's certainly already been in the press that we're considering the notion of a quantitative threshold, so actually putting a number out there and trying to provide guidance as to how long we'll keep this policy in place relative to an unemployment rate and relative to some kind of point of discomfort with inflation. Okay. So it's possible that something like that would come out.
Okay, let's talk for a second about the potential distortionary effects of current Fed policy. Current Fed policy is of buying the Treasury bonds, buying other things, but Treasury bonds, and the Treasury yield is arguably one of the most important prices in the U.S. economy, and the Fed is, as part of policy, suppressing that yield. And if we just think out loud for a second about some of the potential distortionary effects, what are some of them that come to mind that you worry about and keep your eye on?
Well, the effort to put pressure on long-term yields is the policy.
Yeah.
So that's really what we're trying to do. So maybe someone could argue that that's a form of distortion. I look more at market functioning.
Mm-hmm.
I think we don't want to be in a position that our operations are really harming the functioning of the market with lasting potential.
Mm-hmm.
Behind any market are institutions. There are people working in those markets. If you get too dominant in a market,
Right.
so that the private players no longer have a profit incentive to stay in the market and they go to other things, you end up distorting the market from really in a basic operating sense for the long term.
And are you speaking of the Treasury market here or other markets?
Well, the Treasury market is a very, very large market.
Yeah.
And with all of our activity, we still control, depending on how you want to measure it, around 20% of the market. I'm thinking really more of the mortgage-backed security market.
Got it, okay. Dennis, let's talk about international developments, and are there some particular aspects of the international economy that are worrisome to you at this point?
Well, certainly we continue to monitor the situation in Europe and how it's evolving, and pay attention to a risk that could give rise to some kind of a shock. I tend to think of that as maybe something that causes a bank run in one of the peripheral countries. Recently, we all watched the vote in the parliament in Athens, in the Greek parliament, and that raised concerns and certainly raised, in some respects, a little bit of a risk-off environment. So Europe is definitely something to continue to watch, and it strikes me that it's a problem that will go on for quite some time. It's not easily resolvable in one decisive decision.
Let me ask a question on that. As president of the Atlanta Fed, you have to think about bank supervision and bank regulation. Mm-hmm. There's a lot of hope that Europe can put together very, very quickly a body that will supervise the banks across many countries. Mm-hmm. This seems to me to be an impossible task to do in months. It's more years to build this up. What's your view on that?
Well, I believe I'm right that the ECB, the European Central Bank, has been designated as the body, so that you have an institution in place. It's not as if they have to ramp up an institution from absolute scratch, but certainly it would take time to put in place all the processes and all the methods and so forth, get that populated with a staff and get the expertise in place. So I don't think you view it as a short-term fix in any sense. This is part of the process of the Europeans actually changing their institutional arrangements, and it's going to take some time.
It'll take some time, right. Good. So I'd like to thank you, Dennis, for coming up to Charlottesville and Darden and joining us for the investment conference, and I hope you're able to return again soon.
Thank you very much, Frank.
Thank you.